Welcome, everyone. We're diving deep into the pulse of global markets today, specifically looking at the landscape around June 18th, 2025.
Yeah, and you've brought a really fascinating set of sources for us to dig into.
Absolutely. Our mission really is to cut through all the noise. We want to deliver the essential insights, maybe some surprising facts, and those crucial connections so you feel truly informed.
Think of it as a shortcut, maybe,
Yeah.
to understanding the key drivers moving economies, moving assets right now.
Exactly. Everything from the S&P 500 to Bitcoin. And we want to give enough context so you grasp not just what's happening, but, why it matters.
And the source material we're working from today is this detailed market outlook. It's
Yeah.
packed with fresh data, expert analysis.
Right. It really distills a complex world into hopefully clearer trends and maybe some actionable insights for anyone who's curious about this whole global economic dance.
It definitely tries to. What this outlook really highlights, I think, is the hypersensitivity of current markets.
Yep.
Well, we're seeing billions wiped off indices like the S&P 500 almost overnight sometimes because of geopolitical tremors happening, far away from Wall Street. It just underscores how deeply interwoven global stability and market health really are now.
That's a critical observation. And it leads us straight into the big news in the U.S. markets, doesn't it? The S&P 500 recently slipped,
Yeah, significantly.
losing nearly $600 billion in market cap just mid-June. I mean, that's huge.
It really is. Roughly the market cap of, say, a Netflix or a Tesla, just gone in days.
So after a shift like that, what are analysts saying about where we head next? Because I've seen this remarkably wide year-end forecast range.
Oh, it's all over the place.
Yeah, anywhere between, 4,800 and 6,500 for the S&P 500?
Exactly, and that massive range really points to the crucial factors everyone's watching. Inflation data, number one, and Federal Reserve actions.
Which raises that important question, just how sensitive are markets to signals from central banks right now?
Extremely sensitive. I mean, all eyes are on Federal Reserve Chair Powell this week. Traders are basically parsing every single word.
Looking for any hint of a policy shift.
Any hint at all.
Yeah.
It just highlights how much market direction can literally hinge on one speech from the Fed these days.
And, okay, here's an interesting tension point we're seeing, right? Stocks are rallying, especially in those AI-driven sectors everyone's excited about.
Right. There's definitely excitement there.
But the technical indicators like the RSI, the Relative Strength Index, they're flashing overbought.
Which usually signals caution.
Definitely. Analysts are advising caution. It shows that kind of delicate balance, doesn't it? Between the excitement and the potential for overheating in some areas.
Absolutely. It's a tricky line to walk.
Okay, let's shift our gaze over to Europe. What's the picture there? Because it seems like political turbulence is really translating into market jitters.
That's exactly right.
Yeah.
You look at Germany's DAX, their main index, it's under pressure.
Yeah.
And France's CAC 40, well, that's seen significant volatility right after their elections. And if you connect that to the bigger picture, it's just a prime example of how internal political dynamics, they aren't just local news anymore.
No.
They become immediate confidence indicators for global investors. It's like a real-time stress test on a country's stability and economic future.
And for traders focused on the Eurozone, there's a speech from the ECB, the European Central Bank, coming up today.
Yes, that's right.
So you'll want to watch that closely. Look for any specific signals about rate cuts or maybe lingering inflation concerns. Those comments will definitely move the needle.
No doubt about it.
Yeah.
Now, moving across the globe,
Yeah.
let's look at Asia. China and Hong Kong markets, they're, steady-ish, but seem to lack clear direction.
And that's still the real estate sector hangover.
Primarily, yes. That ongoing stress in their property sector is still weighing things down. It's not just about a few developers struggling anymore. It's become a systemic concern. It affects broader economic confidence, capital flows. It's just this persistent headwind.
Right. Given how long this China real estate issue has been dragging on, I mean, are we seeing any new developments, or is this just something investors need to factor in for the long haul?
It feels more like the latter right now, a prolonged drag.
Okay. And what about other Asian markets? Japan's Nikkei 225, their benchmark index, you mentioned it remains bullish, but maybe losing some steam?
Yeah, still positive overall, but the upward momentum seems to be slowing a bit. Needs watching.
So what does all this mean for other parts of Asia, say India?
Well, India's Nifty 50, their key index, it's holding around the 24,800 level. There's definitely potential there for a breakout if global cues turn more positive. It suggests a certain underlying resilience despite some of the regional pressures.
Okay. And speaking of India, let's look at the currency. The USDNR today is at 86.29. That's nearing a 2-month low for the rupee. What's driving that weakness?
Yeah, the rupee's been dragged down mainly by two things: rising oil prices and increased import demand.
Okay, explain that connection.
Sure, think of it like this. India imports a lot of oil. When global oil prices climb, India needs more US dollars to buy the same amount of crude oil.
Right. Basic supply and demand for dollars.
Exactly. So that higher demand for dollars plus demand for other imports puts downward pressure on the rupee, weakening it against the dollar.
Makes sense. Okay, let's pivot now. Commodities and crypto. Raw materials and digital assets. These are often the quickest barometers of global sentiment, right? And geopolitical shifts.
Absolutely. They react fast. Take Brent crude oil, for instance. It's trading near $77 a barrel.
Which is a 5-month high.
Sitting 5-month highs, yeah. And just to underscore the point we made earlier, those escalating Middle East tensions, they are undeniably the primary driver here, feeding directly into supply fears.
And how are precious metals and crypto reacting? Gold in India, for example, is at 9,420 per gram. Still looking pretty bullish.
Yeah, gold's holding strong. Meanwhile, Bitcoin is hovering around $105,650.
Which translates to about, what, 9.09 lakh per BTC in India?
Roughly, yes. And for Bitcoin, the sources we looked at really highlight a key level, a clean break above $108,000.
Okay.
That seems to be the threshold that could trigger the next significant move upwards.
And for people tracking other cryptocurrencies, the altcoins.
Yeah, it's really important to always check the Bitcoin dominance charts. Those show Bitcoin's percentage of the total crypto market cap.
Why is that so crucial?
Because it helps you understand the broader market dynamic where capital is actually flowing. Often, Bitcoin's move tends to lead the rest of the altcoin market.
That's a really practical tip for anyone navigating the crypto space. And a general point for this week, watch for volatility in both oil and crypto.
Definitely. Both are highly sensitive to global events right now. They're going to react quickly to news, geopolitical shifts, you name it.
Okay. So pulling this all together now, let's talk about the core theme and maybe a crucial mindset tip for the week.
Yeah, the theme we pulled out this week is think global, trade local.
Okay, what does that mean in practice?
Well, in practical terms, it means recognizing, for instance, how crude oil prices, driven by events maybe thousands of miles away, directly affect your local currency.
Right, and inflation where you live.
Exactly. Even if you're nowhere near an oil field. Or, another example, how a strong U.S. dollar globally can put pressure on emerging markets all across the board.
Seeing those ripple effects?
Precisely. It's about connecting those dots.
I think that's really valuable for anyone trying to make sense of all this complex information flying around, which leads to the mindset tip for the week.
Yes. It's simple but powerful. React with logic, not emotion. Let global drivers guide your local trades, not headlines alone.
Looking beyond the surface noise. I like that. So let's recap. We've really taken a deep dive into global markets today. We've uncovered some of the key forces at play, from geopolitical tensions in the Middle East shaping oil and U.S. markets.
On central bank actions over in Europe, and even those more subtle shifts in Asian real estate.
Yeah. Hopefully, you now have a clearer picture of how interconnected all these forces are, often in quite surprising ways.
We really hope this deep dive has given you a fresh perspective. How global events, even ones that seem really far removed, can ripple through markets.
And affect everything from currency values to commodity prices right where you are. Maybe consider how these global drivers could subtly influence decisions in your own field or just your interests.
It's good exercise.
So, as you go about your week, maybe ask yourself, beyond the headlines, what are those deeper underlying connections you can spot between seemingly disparate global events?
And how might understanding those connections actually shift your own approach to just staying informed?
It's been a real pleasure exploring these insights with you today.
Likewise.
And we look forward to our next deep dive together. Stay curious.